All right. So, well, now we've had the announcement and it's unchanged. So what is your reaction to that?
I mean, as expected, right? Okay. But I want to point out something that J.D. said, and I think this is really important, that financial markets are reactive. They are not necessarily the be-all, end-all, especially in the short term. And in some respects, the financial markets have been very tough for the last couple of years, right? 2022 is a terrible year for stock and bond investors. This year, the stock market went up pretty dramatically over the first 6-8 months, but now has come off. We're coming off a 3 consecutive months lower for the S&P 500. So what does that tell you? Should you get out of everything? No. I think the most important thing is that the financial markets over the long term are pretty rational. But in the short term, and that can be months and even a year at a time, it is a real knee-jerk response, our emotional response to what we think is going on. And at the end of the day, companies will either make money or not make money in this higher interest rate environment, and those will deliver the returns to investors over time. But please try not to react to these day-to-day gyrations.
Is this good for the U.S. economy?
What's that? The fact that rates aren't going higher? I mean, I think that, again, that remains to be seen. What's I think really interesting is the separation between this and previous Fed meetings. We can't forget to remind our viewers here that we only get 8 of these a year, and we only get 4 of those meetings where we get what's called the summary of economic projections or the dot plot analysis. I'd argue last time around in September, that's really what ended up moving the markets late into the close. We don't have one of those today. So the best information we have to go off of in terms of where members of the committee are going from here are basically still that September data. Now, that's several weeks ago. So a lot of the main points have certainly changed, but there's a lot of pressure points on the economy. We talk about the resumption of student loan payments, the potential for a government shutdown come November 17th, ongoing geopolitical instability around the world. All of these things are things, especially in terms of concerns on spending, concerns of inflation, and on interest rates that we know the central bank is very closely watching.
You know, I also have to say that with all due respect to the great research being done at the Federal Reserve and the wonderful people there, they've blown it. They have not gotten it right, gang. They are no smarter than any other economists on the street. So if we go back to January, there was a universal belief, even among the Federal Reserve officials, that there would be a recession in 2023. Why? Because if you look in the past, every time when the Fed has raised rates by so much and so quickly, it has not just slowed the economy down, it's pushed the economy into a recession. Here we are, 10 months later, guess what? No recession. And right now, if you look at the futures markets, the betting markets about what would happen in the last Fed meeting of the year, there is still a slight number of folks who do believe there could be a 1/4-point increase in December. I'm not sure that they've got that right. I don't think that the Fed is going to act anymore, but I also don't think that when the Fed chair speaks that he is going to say, oh, we're all done. We're just going to eat bonbons for the rest of the year.
And it would be nice, though.
Right, it would be nice. And I think that what we really have to remember is economists are human beings. They build on models that are created over time. This once-in-a-century pandemic was a game changer. They did not know how to predict coming out of this. The economy has remained stronger than they expected. That's good news. But it also means that interest rates could stay at these higher levels for a longer period of time. That makes it tough for borrowers. It makes it tough for anyone who wants to go buy a house. It makes it tough that if you are looking to maybe re-up a loan that's coming due as a small business owner, these are hard times. But if you're a saver, you're dancing a jig, ma'am. Like it has been 10 years since you have seen 5% interest rates in your money market accounts. And gosh, you deserve it.
J.D., the central bank also paused rate hikes at its last meeting, as you mentioned. How is today's decision different from its previous decision in the terms of the impact on Wall Street?
Yeah, absolutely. Well, I think, again, that dot plot projection that we don't have this time around is going to be kind of a bit of a missing piece for investors that they don't have in the short term. But we will get one again come December 13th. That will be very closely watched, right? And it's really interesting. It's kind of an anonymous survey. The voting officials of the committee get together. They weigh in. Where do they think interest rates will go? Where do they think unemployment will go? And then we end up taking a lot of cues for that. I would also argue, in my opinion, this is a bit of an anomalous Fed week. I think usually when we have the Fed announcement, it's probably the biggest issue that has the potential to move markets. I'd actually argue not just as today Fed Day, it's also Apple earnings eve. That is the big one for tomorrow. After the bell, Apple is 7% of the entire S&P 500, the biggest company market cap out of any company in the world. If there is a single market moving event this week that I think most market participants are closely watching, arguably, it may not really be today's Fed announcement because, to Jill's point, this was largely expected. But there are a lot of uncertainties in terms of iPhone success for Apple and news out of China. Apple makes about 20% of its global revenue out of China alone. I think that's really the big one that may have the potential to move markets that we did not have as a set of circumstances back time when the Fed was there in September.
And you know, another really important thing is this week we have a jobs report. So we have a jobs report that comes out on Friday, 8:30 Eastern. And the last jobs report, again, speaking to how economists have really not quite figured out how to project in this current economy, we had more than 300,000 jobs created in the month. It was so much higher than expectations. It literally left economists saying, huh? And I think in this current one, we're expecting 150 to 200,000 jobs. But you know what? Let's not be surprised. It could be 100,000 print. It could be a 300,000 print. What is clear is that the strength of the jobs market and the ability for consumers to be able to float these higher rates has so much to do with wages being higher, with the job market being strong. Maybe people aren't quitting and running to find new jobs as in those great numbers as they were, but it is a job market that allows people to feel some sense of comfort that they can manage their current financial situations.
Some security.
Absolutely.
Jill Schlesinger, J.D. Durkin, thank you so much for breaking it all down for us. Appreciate it.
Thank you.